There are only 4 concepts you need in order to be a profitable trader whilst avoiding psychology problems. The whole time you have been searching for the best trading strategy when it has been right in front of you the whole time. This is a course for absolutely anyone who has an interest in trading. You might think this course is basic, but as we go deeper, you will realize that the most simple way of trading will yield the greatest results. Firstly, what is currency trading? Simply put, we are buying and selling currencies. It is essentially betting that the price of one currency will go up or down against another. We trade these currencies in pairs. For example, the euro against the dollar, euro USD. If you position yourself correctly in line with the movement of price, you can potentially make money on that bet, unless your stop loss is hit or you close the trade. To be able to create a profitable trading system, we must outline our goals. We need to be able to predict where price will move to. If we can do this with a win rate that suits the risk to reward, the system will be profitable over a long period of time. Win rate is the amount of wins out of total trades taken. Risk to reward is the ratio between how much you risk per trade and the potential reward. The higher the win rate, the lower the risk to reward needed. The lower the win rate, the higher the risk to reward is needed. Let's first take a look at the movement of price. How is the movement of price displayed? The most popular chart and the one majority of traders use is the candlestick chart. The candlestick chart displays price in candles. A candle consists of the open price, the close price, the highest price and the lowest price, in the sequence of open, high or low and close. We can view candles in different time frames. For example, a 1 hour candle will open at 1 PM and will close at 2 PM. The open and close of the 1 hour candle will always occur at the same time. The high and low will be determined by the lowest price and the highest price level the pair has reached within the 1 hour open and close. This is the first and most important objective concept that you can use to predict where price will move to. We can only guarantee one thing on a chart. A candle will open and close at certain times. The movement in between the open and close is random. However, if you use the open, high, low and close in a certain sequence, you will be able to craft a profitable trading system. In this course, I will only teach you concepts that are proven and are based on fact. You might have seen other courses teach you about indicators like RSI, Bollinger Bands, or Elliott Wave Theory, or even certain smart money concepts like order blocks, breaker blocks, or supply and demand zones. There is no irrefutable proof that these concepts are real or that they work. No candle has order block written on it, neither do supply and demand zones. If you were to ask 100 people if a certain candle is a supply zone, you will get some people saying it is and some will say it's not. This is because all concepts mentioned above are subjective. The concepts are interpreted differently by each individual, especially if they are taught by different mentors. If you were to ask 100 people what the open, high, low and close is of a certain candle, you would get the exact same result from everyone. This is what an objective concept is. Objectivity is judgment in a fair way that is not influenced by personal feelings or beliefs. This might sound very obvious. However, if you only use objective concepts to create a trading system, if that system is not profitable over a long period of time, then you can blame the system and not the individual trading it. If you use subjective concepts, the reason for unprofitability can be the system or the trader or even both. Okay, you have outlined your goals. You have chosen to trade the markets using purely objective concepts. So how can simply the open, high, low, close give us insight on where price might be heading to? Singular candle does not give us enough information to make a prediction on where price might be going. However, just two candles can give us an insight on where the third candle is likely to head to. The first concepts we can use from open, high, low and close is a sweep. A sweep is when the second candle trades below the previous candle's high or low, but closes inside the previous candle range. A candle range is just the range between the high and low of a singular candle. If you see a sweep of a previous candle, there is a higher probability chance that the third candle will target the opposing candle range high or low. In this scenario, we have a down candle. The close is lower than the open. This is called a bearish candle. The candle to the right is an up candle, which is known as a bullish candle. The candle opened and traded below the previous candle low, but closed above. This is what a sweep is. You might have heard people call this a liquidity sweep. This works well on a daily time frame. For example, if Tuesday's daily candle sweeps Monday's low, then we can expect Wednesday's candle to be a bullish candle. If we expect Wednesday's candle to be bullish, where would you like to be buying from? Think in terms of open, high, low, or close. Well, you would want to buy below the open of Wednesday's candle to be in a position to catch the majority of the predicted up move. Ideally, you want to use this concept on 1 hour candles and above. The higher the time frame of the candle range, the bigger the range will be, which will give you more room to trade with. Here is an example on the chart. This is not enough for a trader model. It will figure out your general bias, but we can still use more concepts to give us a robust trading system. And we can use a combination of time frames to create more rules which will increase the win rate of the strategy. But how do you find out whether your system is profitable over a long period of time? Backtesting is looking at old price action and applying your system to see if it's profitable. You can use the replay function on TradingView or FX Replay. This gives you the tools to test your strategy whilst saving times. If you were to test this in the live markets, you would only be able to get 6 months worth of data in 6 months. However, if you backtest objectively, you can gain 2 years of backtested data in 6 months. The more data you have, the more useful it will be, as you will have a larger data set. This gives you the tools to test your strategy whilst saving time. Backtesting is most useful when testing objective concepts, as, in theory, anyone who tests the objective strategy should get the same results. The same cannot be said for subjective concepts. In the next video, we will take a look at more objective concepts and how they can give us an insight into where price is likely to head to.